Is it visible now? Is the slide visible?
No, sir.
Is it visible now?
The screen is visible, sir.
Let me see what is happening. Is it visible?
Yes, sir.
What is written?
Wealth maximization.
Okay, then let me make it full screen and then we should start. Is all right now?
Yes, sir.
We have already started to discuss about this profit maximization versus wealth maximization in the last class. And I have given you a bit amount of detail about this profit maximization and what this wealth maximization is. The basic understanding of wealth maximization is the complete welfare of the equity shareholders. Our focus is very much clear. If you see from the very beginning, the scope of this study, there at that time we have told that, okay, we will be concentrating mainly on the public limited company under private sector. And after that, we have also discussed that our main focus will be the equity shareholder, those who are the owner of the business, and they are bearing maximum risk. Now the question is that with the operations of business, the company should provide maximum benefit to them. And generally we know that, okay, the organizations, they exist for the purpose of earning profit. So the profit should be maximized. This has been the basic objective of the organization for a very long time. But over a period of time, this profit maximization as the sole objective, that has been modified. And from the social point of view, so many objectives they have also been added. For example, the corporate social responsibility. This is what now we are talking in terms of sustainability, the green management. There are so many things, so many new ideas they have been brought, considering the nature of developments which have taken place at the international level, and the damages whatever has been done to the environment. So many other objectives they have also been placed before. And this profit maximization, in case of finance, we are considering that, okay, it is not the profit which is important, it is the wealth that is very much important. So that first of all, we will have to understand what this wealth is and how it is different from profit. For profit, I have already discussed with you that whenever we are going to calculate profit, so the profit, they can be calculated in many ways. And one important part was that, okay, we are going to calculate profit, which is earning after taxes, because from this amount we are going to distribute to the shareholders the preference dividend and the equity dividend. We know about that. These are the very basic things which are clear to you. You understand it. Now, from this point of view, the number of shares whatever are held by the equity shareholder, or the total number of shares which have been floated by the company for the purpose of collecting money from the market, and when the total amount after payment of taxes, we are going to divide that amount by the number of shares. We get what we call, you are familiar with this terminology, that is earning per share. So how much is the earning? So earning is earning after taxes, and we are dividing this amount by the number of shares. So this is the earning per share. For 1 year, you are going to consider it for so many years. So profit can be calculated. We have already discussed. Now see the another point. The finance people say that, okay, you are considering profit. So it may be long-term profit or it may be short-term profit. Your idea may be there, and you say that, okay, it is not the short-term. We are interested in long-term profit. Why? Because when we are going to start business, in the beginning, customers don't know about our product, our company. They don't have confidence, so naturally they will not be buying in that much quantity. So we are going to supply sometimes at a lesser price, so that the competitors' customers, they should switch over to our product. And in that case, in this pursuit, you may be sustaining loss. So what is our understanding, what is our idea as a business, that it should be the long-term profit. So what is the position of that? So 5 years, 10 years, whatever is the case, you are going to consider. They say that, okay, profit, but if suppose you are considering profit, and that is the long-term profit, then that is also not going to solve your problem. They say that, okay, the timing of profit, if you are going to consider, that is also not going to help in taking decision. And for that purpose, I am having very simple example here. And see, there are two companies, company A and company B. In case of company A, in the first year, the profit is 10,000, second year 20, third year 30,000, fourth year 40,000, and fifth year 50,000. This is company A and its profit. There is another company where it is profit in the beginning, that is 50, second year it is 40, third year it is 30, fourth year it is 20, and the fifth year it is 10. Both are possible. It is not that it is impossible. See, generally you will find, in case of electronics goods, whenever any new product is being introduced, take for example your mobile phone, when it is introduced in the market with so many additional features, what the company is doing, they skim the cream pricing, which we have already studied in marketing, because they know that whatever price we are going to charge in the beginning, because the competitors will also come with the additional features. So in this case, what happens, in the beginning you are going to get more profit, and gradually your profit is going to be reduced. So it is not that, okay, this is possible, this is not possible. Both the cases are possible. We find in case of the economy. But see, here the question is that these are the 5 years data. And 10, 20, 30, 40 and 50, 1,50,000, you are considering that, okay, this is the total profit for 5 years period. Here also, it is 50, 40, 30, 20, 10, 1,50,000 here. Now you will say that, okay, there is no problem, I am having 1,50,000 in case of company A or in case of project A or whatever you are considering in case of investment A. And in case of company B also, we are having within 5 years this 1,50,000. So if your profit maximization as a concept you are going to say, then the long-term profit is same. You will say that, okay, well, whether it is company A or it is company B, it is immaterial for me because within 5 years, both the companies they are going to have same amount of profit. But the finance people say that no, this is not the correct proposition or this is not the correct interpretation of your earning over 5 years period. They say that here, in this case, you are getting 10,000 in the beginning. And in this case, you are getting 50,000 in the beginning. What is the difference? The difference is the time value of money. If the time value of money you are considering that, okay, today it is then 10,000 versus 50,000. Next year it is 20,000 versus 40,000. And then 30 versus 30. Here you will say that, okay, they are same. But here it is 40,000 versus 20 and 50,000 versus 10. Early money is better money. Finance people, they are already emphasizing this part. The time value of money, which I have already discussed in brief, the concept of it. You are getting early money, so what will you do in that case? You will be paying more amount of dividend to the shareholders. They will be investing that in some outlets, whatever are available to them. Or if you are not going to pay dividend that much, you will be retaining some amount and you will be investing it. And by your investment, you are going to earn additional profit, which will not be possible in this case because the amount is very low. The amount is very small one. But here, quite good amount of money you are having handsome amount. So here in this case, your investment is there. Now see, after 2 years, here you are getting only 20,000. Sorry, after 1 year. Here what is happening? It is 40,000. If you are going to consider that the value, if you are going to calculate for today, the 40,000 and the 20,000, they will not be same. We are not considering that 20,000 after 1 year and 40,000 after 1 year, they will be same. Their value is not the same. Then in that case, here it is 30,000 which you are getting, and here it is 10,000 which is coming after 5 years. But here you are getting 50,000 after 5 years. When you are going to calculate its present value with the help of certain discount, you will find that the present value of this, the company B, that will be more as compared to the company A. Why? Because 50,000 you are getting in the beginning. So when you are going to reduce by a particular percentage, you will be reducing 50,000. So its total value will be more as compared to when you are going to reduce this 10,000 by the same percentage, its value will be less. And here in this case, 50,000 you are getting after 5 years. So its value will not be comparable with this value. No doubt, in terms of amount, they are same. So the finance people say that when you are considering long-term profit event, we are not in a position to say that, okay, what is the correct situation in that case. Because you are simply considering that, okay, over 5 years period, I am getting 1,50,000 in case of A or in case of B, so I am indifferent in this case. But finance people say, no, your company B is giving you a better return as company A. Why? Because early money is better money. So 50,000, 40, 30 and 20, 10. Here in this case, you are getting money early. Here in this case, you are getting money later stage. So within this period, it is 60, whereas it is 30 plus 40, 70 plus 150, 120. So here we say that, okay, later stage you are getting more, beginning here you are getting more. So in this case, your company B is better as compared to company A. Details we will be able to calculate at the later stage when the time value of money that will be discussed. So they say that no, profit maximization, if you are going to consider as the objectives of the business, that will be misleading. It is not going to help you in taking the correct decision. So this is the opinion. They say that okay, it is the criticism related to that. So first one was that okay, which profit you are going to consider, earning before taxes, earning after taxes, earning per share, which profit you are going to consider. Here in this case, they say that okay, the time you are not going to consider, that is very important in case of financial decisions. So the profit maximization as the objective, that is not the true objective, it is not going to help you. So now see the cash flow part. See, this is another criticism which they are putting forward. They say that a greater earning per share doesn't mean that increase in cash and increase in dividend payment. It is the cash flow that is important. Greater EPS or greater earning after taxes, they don't mean that it is going to increase cash or increase in the dividend. So this is another criticism related to that. In case of this cash flow, we have already considered that in finance, we are considering cash as the most important factor. The inflow of cash and outflow of cash. That is going to determine, or on the basis of that, we are going to take decisions. Our accounting system is not cash based, so whatever accounting information are available with the help of your accrual system of accounting, there are differences between the two. So the cash flow, this profit calculation is not related with the cash flow. There are so many other adjustments which we have made for calculating profit. It means what will happen? You may be having higher earning per share, but your cash position will not be seen to support the payment of dividend to the shareholders. This point you have to understand very clearly, and this aspect, this understanding we are going to carry till the stage of dividend payment. Greater earning per share doesn't mean increase in cash and increase in the dividend payment. They say that it is not the earning per share or the profit which you have considered. It is the cash flow. What is the position of cash flow? That will determine how much you are going to pay in the form of dividend, not the profit or the earning per share, whatever you are having. You may be having 5 rupees earning per share, but you will not be in a position to pay even 2 rupees to the equity shareholders. That's why generally you will find the EPS and DPS, when we are having this dividend per share, generally you will find that earning per share will be more, dividend per share is less. One reason, I don't say that all the reasons are related to this. One reason sometimes you will find that the company is not having better cash position to pay the dividend. So they say that okay, if you are considering this earning per share, which is the indicator of your profit, as the basis of taking financial decisions, it will not be helping you in payment of dividend to the shareholders, because your cash position is not indicative in case of your earning per share. So the earning per share, which is an indicator of profit, we understand that when we are considering that the profit should be maximized, naturally the earning per share that will also be maximized, but it is not going to help you in taking this decision that okay, the earning per share is there and we are going to pay to the shareholder based on that, because it is possible that earning per share is more, but the company's cash position is not that sound to pay the dividend. So increasing profit, so what they say, this is another explanation which I had already given you yesterday, that you can increase profit by reducing the research and development expenses, may reduce the price of share at the stock market. So this is the other implication of increasing your earning per share or profit. You have reduced this expense, what will happen in them? Then in that case, your price, your profit will be more. But when you are going to reduce this, the investors, they are not going to consider it as a positive sign. Why? Because they will consider that when you are not spending on research and development, in future, your product and services, addition of the attributes in your product, additional features to be added in the full product, that will not be coming, and the customers, they will be switching over. It will be reducing your earning in terms of revenue. It will be reducing your profit. So in future, what will happen? So it is going to affect on the share price. So the cash flow is another important part. And the most important part, which is here. In case of profit maximization, you see that these two companies, when we have considered this company A and company B, we have not taken up, we have simply considered that, okay, 1,50,000, 1,50,000. They are same, so we consider both the companies are same in case of profit maximization. Not under wealth, it is different, because time value we are considering. But, and here in this case, we have not considered whether the company A is under more risk situation or company is working under more risk situation. Because risk is always there in case of market. We cannot ignore the risk. You cannot 100% reduce, or you cannot make it zero. It will always be there, because without this risk part, you will not be able to earn. So risk is one important component which is always there. And in case of financial decisions, this risk is basic indicator, because whatever decisions you are going to take, you will have to analyze what is the position of risk in case of that particular decision, and how much return you are going to take out of this, and what is its impact on the value of the firm. So the final stage of our decision, which is the basic indicator where you have to focus, that is the value of the firm. We will discuss it later. At this stage, as a criticism of profit maximization, we consider that the risk part we are not considering under profit maximization. The two companies A and B, we have considered, okay, 1,50,000, 1,50,000. In what type of risk company A is facing, what type of risk company B is facing, we have not calculated, we have not considered. So they say that the finance people say that the risk is the another important element which we are not taking into account while taking decision based on the profit maximization. So now coming to the risk part, see here, very simple aspect that has been mentioned here. Profit maximization disregards risk. So it is not considering, it is not taking into account, it is not going, it is not, it is not taking that, okay, what is the risk position. See here, the risk that has been defined here, very simple. In finance also, in general terminology, we are using this term in this manner. The chance that actual outcome may differ from those expected. How we define risk? Risk is the chance that actual outcome may differ from those expected. See, at this stage, we have to understand certain things which are basic, but they will continue to be there with us throughout the understanding of this particular course. Whenever we are investing in any business, we are expecting that it will be giving return over this number of years or over this period, the return will be coming. The question is that whatever you are investing, that is today, but how much you will be getting after 1 year, 2 years, up to 10 years, that is future. And for future, we are knowing that future is always uncertain. Uncertainty is there with future, always keep this in mind. And this uncertainty, the uncertain aspect of future, that will be affecting your different type of decisions. You have calculated the market condition is going to be same for 5 years or 10 years period. And under that condition, you are going to get this much return from your investment, all right? But during this period, many changes, they may come in, they may creep into it, and whatever calculations you have made, they may not be met. In 2019, we were not knowing what this COVID is, but we are facing it for last 1.5 years. So no one has expected that such type of situation will come. So this type of conditions, they will come, we are not knowing about that. So risk is always there. But now the question is, then what is the purpose of calculating or what is the purpose of gauging how much benefit we are going to receive in future? You will say that then it is useless once you are not in a position to calculate, or you are not in a position to gauge that, okay, how much return you are going to have. See, under normal conditions, fluctuations, they are going to take place. Government that is going to make different type of rules and regulations. These rules and regulations, they are going to affect the decisions related with the company. They will also be affecting the return to the company. So the risk is always there. And the risk from the competitors, which we have already considered that we are operating in a competitive market. So the abnormal profit you will not be able to earn for long. Other companies, they will also enter. There is curse of competition. We have considered that particular principle. So in this case, what will happen? Whenever we are calculating, when we are having different type of indicators, we are going to plan for that. We are calculating how much return we are expecting. Very first thing which you have to keep in mind is that you must have confidence in the data, whatever you have calculated for future period. Always keep this in mind. Whatever calculations, whatever data you have generated and you have calculated, considering the different variables which are affecting on the company, you must have confidence in that data. Very important part is this. Otherwise, all the time you will say you will be having checking behavior, and you will say that, okay, what will happen? It may be or it may not be. Then all calculations, they will become null and void. They will say that, okay, it is useless. So the risk part, I am coming to this. The profit maximization disregards risk. What is risk? The chance that actual outcome may differ from those expected. You have expected something and your actual outcome is not the same. It means there is risk. You have expected something more, you are getting something less, it means that there is risk. Risk and return are the key determinants of share price. Now see here, the share price I am using, I will be coming to this part just after this. So risk and return are the determinants of share price, which represents the wealth of owner in the firm. Now see here, I have not mentioned about the dividend part. Dividend is of course related with the internal operation of your business, considering the different projects which will be financed, how much amount of money you are going to pay. But here, whenever we are considering wealth of owner, here it is the share price that becomes dominant. And this risk and return are the determinants of the share prices which are in the stock market, which represents the wealth of the owners in the firm. Higher cash flow is generally associated with higher share price. If your company is cash rich company, we consider that, okay, the share price of your the shares of your company, that will be priced higher. So here in this case, higher cash flow is generally associated with higher share price. We have already considered that higher is the risk, higher should be the return, expected return. So if any risky project you are going to consider for the purpose of investment, you should also expect that the return should be higher. So there are different other combinations which we will discuss at the later stage, maybe in the specialized courses. So higher cash flow is generally associated with higher share price. Higher risk tends to result in lower share price. Now see here, higher risk tends to result in lower share price. How? The example is here. Okay. The example is here. A lawsuit in the court may reduce the price of the share. There is some litigation with some parties, some companies, and that you have written in your balance sheet. Of the balance sheet, this has been written as a contingent liability, that there is a lawsuit, and maybe if you are going to lose this much amount, we will have to lose. And this has been mentioned. That is a contingent liability. Sometimes we are going to write it. depending upon the accounting system you have adopted and how it is you are going to meet that. So lawsuit is there in the court, which may reduce the price of the share. Why? If it is settled against the company, it will have to pay a large amount of cash in future. So what the investors are thinking? Investors are generally risk averse. Now see here, this is another term which you have to understand. There are risk takers, risk averse. Risk takers are those who are going to take risk. But in general, we consider that the investors, they are not risk takers, they are generally avoiding risk, they are risk averse. So investors are generally, so here it is the term generally, it is not all the times. There are some who are interested in who are very much interested in taking higher risk because they expect that, okay, and there are chances that the reverse result that is possible. So, but in general, because we are considering that the investors are rational human beings. Now, so the behavioral side of the investor, we are considering that they are a rational human being. That means whenever they are going to make investment, they will be calculating cost and benefit because the rationality demands that. But we are also finding that they are not simply rational, but they are emotional also. They are going to decide on the basis of their gut feeling, and that maybe telling them something reverse. But in general, we say that, okay, investors are generally risk averse, that is, they want to avoid risk. The difference in can significantly affect the value of an investment. So what will happen in this case? A company has got this contingent liability. If the company is going to lose, it will have to pay a large amount of cash in future. What the investor is thinking in this case, then he is not going to buy the share at higher price because he understands that the position of this company will not be as sound as it looks today. So investors generally say, well, they want to avoid that risk. So difference that can significantly affect the value of an investment. So in this case, they are not going to purchase the share of the company. So what happens in this case? The higher risk tends to result the lower share price. Higher risk, generally we are relating that the higher is the risk, higher is the return. But in this case, what is happening? Higher is the risk, but the share price that will be low because he considers the more amount of money the company will have to pay when the suit is going to be decided in favor of the other party. Naturally, no one is going to purchase share of that company at a higher rate. So the risk is there, then in that case the price of the share that will be reduced. So there are different type of combinations which we find. All the time they are not going to be true. So this is not like universal truth. There are certain things which are coming in between. But in general, whatever things are there, and from outside, on the basis of the analysis, whatever we are finding, that part is here. Now see, what is shareholders' wealth? Now, see, try to understand this part. That is very much important. We have discussed so far about the profit. But one thing more which I would like to tell you. Now that is not that much relevant. But one time that was relevant. But just for the purpose of your knowledge, I am sharing it with you. When in the early 90s and or later 80s, when these changes they started to take place in these two countries, USSR and later on China, because they were the centrally planned economy, and the communism that was prevalent as a philosophy of the government. But in case of that, the private ownership of any business that was not allowed. Every business was in the hands of the government, either in the form of cooperative societies or the government used to manufacture, the government used to buy from outside, and they used to distribute. So production, distribution, and the outlets, everything was there, and that's why we say that it was a centrally planned economy. The communist countries, we used to say, centrally planned economies, we used to say. Their basic tenet of the centrally planned economic has been that these intermediaries, the owner, the distributor, the marketers, these intermediaries, they are charging high amount of profit from the customers. So the exploitation of customer is taking place due to these private operators. So the government should interfere in a big way so that the private operators and their role that should be minimized. And the basic understanding was that these private operators, they are charging prices, higher prices for the purpose of earning more profit. So the profit they used to say, and in case of the centrally planned economy, profit used to be considered as a dirty word. This caption we used to use, the profit is a dirty word. They used to consider it like that. So why they say that it was a dirty word? Because their understanding in terms of sociology was that due to this profit part, the labor is being exploited. You are charging high amount of price from the customers, but when you are going to pay to the employees, to the labor, you are trying that as less as possible you should pay to them. So why you are doing it? The understanding was that it is only for the purpose of earning higher amount of profit. So they said that the exploitation of labor, mainly they were concerned with that, because the major part of the major part of the society, they are in the form of labor. Everywhere you will find it like this. And at that time when the service sector was not that much dominant, so the labor force they were used for that purpose. So they used to say that whatever exploitation you are doing of the labor, that is only for the profit. So it is not simply profit, it was the maximization of profit, because you want to maximize the profit. So the profit is a dirty word, so they used to say that no, profit maximization, that should not be the objective of the firm. It should be something else rather than profit maximization. So this was another criticism, but this criticism is not related with financial side. This was mainly concerned with the social side, because they used to say that okay, the labor they are being exploited, because the majority of the population, the working force, they were in the form of labor. So they used to say that okay, for the purpose of profit, you are maximizing profit, you are paying less to the labor, you are not creating facility for their recreation, you are not creating facility for their children education, you are not going to give them transport facility, housing facility, health care, many things you are not going to do for them, and you want to take maximum work from them. Because at that time, the 12 hours working hour that was there, then they have started to reduce them. There are many agencies from the United Nations also, ILO, International Labour Organization. They started to impose this restriction that okay, 8 hours work and something like that. So there is a whole lot of study. Those who will study this industry, they will study that in detail. But for finance purpose, they used to say that okay, it is the profit motive for which you are exploiting the labor. So this was another criticism, but this criticism is not related with the finance side. So generally, we don't discuss it, but we should have idea about that. That's why generally we talk about this aspects also. What is shareholders' wealth now? Coming to the wealth maximization, which we have already considered in case of profit. Now see the wealth part of it. It is measured by the share price of the stock, that is the share, which is based on timing of return, their magnitude and risk. Shareholders' wealth, what is this? Shareholders' wealth, we are going to measure in terms of the share price. This is one very important part, is this of the stock. And this share price is based on what? It is based on the timing of return, the magnitude of return, how much, and what is the component of risk related to that. So these are the three components which we will have to consider, and they will be determining what is the position of the share price. The financial managers should accept only those actions that are expected to increase the share price. So the basic tenet of our decision, the final stage, which we are going to check, what is the position of the share price at the stock exchange. How any decision that is going to affect our share price, that is the indicator, that is the basis of our decisions. How the decisions, whatever we are taking at the company level, it is going to affect the price of the share. That will be the guiding principle for those decisions. Very simple idea which we are having here. We will discuss in detail. See, share. Why we are considering the share price? Now the answer is here. Share price represents owner's wealth in the firm. Maximizing share price will maximize owner's wealth. A very simple idea we are having here. The financial manager should accept only those actions that are expected to increase share price. Share price represents the owner's wealth in the firm. How it is, I will be coming to that. Maximizing share price will maximize the owner's wealth. So here it is not that profit. Profit is related with your company, where you are pricing your product and you have already calculated the cost related to that. And then after you have calculated how much profit you could earn after payment of interest, after payment of taxes, everything. It is completely internal to the organization. But here, many things are external. It is not internal all the time. Because here it is a share price. It is not internal, it is external. Because share price, where it is? The share price is at the stock market, where the buying and selling of share that is taking place. It means that where the buying and selling of any product or service is being done, we say that it has created a market. So the demand and supply, they are available at this market. So the share price represents owner's wealth. We are considering that this is representing the owner's wealth. This is one component of it. It is not the whole of the firm. Maximizing share price will maximize the shareholder's wealth. Now see here. Return, how we are considering? We are considering return in terms of cash flow. Alright. And risk are the key decision variable in maximizing owner's wealth. We have already discussed that in detail. What is the return? What are the shareholders? What is the return? Number one, he gets the dividend. We know about that. Where from the dividend will come? The dividend will come from the profit. Where from the profit? It will be generated by the company by undertaking different type of activities. So, and when are you going to declare this dividend? At the end of the year, when you have calculated the profit. Some companies, they are doing it when the company is cash-rich company, they are declaring it in between also. So the quarterly dividend and yearly dividend declaration, they are also taking place. So the dividend generally at the end of the year, we are going to declare that. And out of where from we are paying out of the current year's profit. There are rules and regulations related to that, we will discuss at the time of dividend decision in detail. But general idea we are having about this, very clear, that the dividend we are going to declare, this dividend will be declared from the profit of that particular year, and this dividend will be declared on the different type of factors which we are having within the organization. If we are having investment opportunities available within the organization, we may declare zero dividend, no dividend this year. That is possible. We are having profit, but we are not going to pay. Why? Because the investment opportunities are available within the company. So we are not going to do that. So the dividend that can be declared at the end of the year, this is one. But the shareholders, they are not going to wait for this dividend, which you are going to pay for 2 rupees per share or 3 rupees per share or 20% or 30%. You are going to pay. They are not going to wait for that. Why? Because the major component is here, the second component, and which we have already discussed in the just now in the earlier slide. It is the capital gain. So the return is in terms of two. One is the dividend, generally at the end of the year, and the second component is the capital gain. What is capital gain? Capital gain is the difference of selling price and purchase price of the share. We are using this term capital gain. And this capital gain we will be using for the purpose of our tax calculation also. So at some stage, this tax calculation, capital gains tax, this is different from the other tax which is being imposed on the regular profit or on the yearly profit of the business. Capital gain tax is something different as compared to the income tax, whatever we are paying on the profit. So capital gain is one. Capital gain is, what is that capital gain? It is the difference of selling price and purchase price. Take for example, 100 rupees share which is being traded for 120 rupees. You have purchased it today for 120 rupees. 100 rupees share traded at the stock market for 120 rupees. And after 1 week, you are going to sell that share in the same market for 150 rupees. So on one share, you are going to get the benefit of 30 rupees. So your investment in this case was 120 rupees, and by selling for 150 rupees, you have got 30 rupees benefit. So your return will be 30 divided by 120. So that will be your return, which is more important as compared to dividend, because here you are going to get this 30 rupees on investment of 120 rupees within 1 week or 2 weeks or 1 month period. Here it is the 365 days you will have to wait, and then after you will be getting it. But here there are chances that today the price was 120 rupees of the share, tomorrow or after 1 week it is 150 rupees. Maybe if you are going to retain it, it will become 180. And there is also a chance that it will become 110, because this is a market, and the fluctuation, the volatility of the market, that is always there. It is based on the mood of the investors who are playing in that particular market, how they are going to see that, how they are considering this particular industry, how they are going to perform, what are the different type of decisions which the government is going to take place. Many factors are working, and the investors, they are going to take the decision that okay, at what price they should offload the share, whatever they are having. So the capital gain, to the welfare, whenever we are talking, maximizing the owner's wealth or the welfare of the shareholder, we are considering dividend. This is one component, and we are going to consider the capital gain, that is another component. The capital gain part is more important in this case because it is coming from the operations of not the business but operation of the market itself. At what price the share you have purchased and at what price you are going to sell that, what is the time in which you are going to do it. Sometimes you are going to retain the share for 1 year, 2 years also. Sometimes you are going to offload within 10-15 days. So the gain, whatever you are getting, when you are going to do that, so it is the capital gain. Now try to see here. It is the timing of return, the magnitude, how much, and what is the risk component related to that. So the shareholder's wealth, these three components we will have to keep in mind. The timing of return, the magnitude, and the risk part of it. So the dividend and the capital gain part we will have to consider. So these two components, they are forming the owner's wealth. Very important component is here. So why I wanted to explain or discuss this with you, because the criticism related with profit maximization and acceptance of the owner's maximization of wealth, they are two different things. The finance people, they are guided by the maximizing owner's wealth. Profit, of course, that is there, because profit will be affecting this part. But the major component for the investor, those who are going to play at the stock market, due to this demand and supply situation, they are going to get gain here. What decisions you are taking at the company, how it is affecting this component, that is very much important. So what we say, that it is the owner's wealth maximization that is more important than the profit maximization. So this is about your profit maximization versus wealth maximization. Timing of profit, risk related with the profit, we are not considering in case of profit maximization. The type of profit, whatever you are going to calculate, we are not considering that. So many things, this profit maximization, that is not considering, which are taken care of when we are going to accept the wealth maximization as the decision criteria for the purpose of taking financial decisions. Now coming to the next component of this, see here the finance functions.
Sir, we have another class.
क्या टाइम हो गया भाई? Let me check. Okay. So the finance function, just within 1 minute, I would like to finish it. See here, we have already discussed with you the development in finance or the evolution of finance. And we have considered that in the beginning it was only on certain occasions these people, they were called or their services were taken by the company. But after some time they considered that, okay, these functions, they have become regular. So the finance people and the treasury function, they become important, and gradually different functions, they started to come into it. So finally what we are finding, the finance functions or financial decisions, we are using them interchangeably. There are 4 types of decisions which we have to understand. And your complete course is based on these 4. It is the capital budgeting decision, or we call them investment decision. This is one decision, very important. Another one is financing decision. Finance function, financing decision, or capital structure decision. Say, we are using interchangeably. The other one is your dividend decision. How much dividend you should pay. This is a finance function. And working capital decision. Different components of this working capital decision. These 4 decisions we are taking considering number 1, risk, number 2, return. And we will have to check in terms of the market value of the firm. So 4 decisions taking into account the risk, return, and the market value of the firm. Detailed discussion will follow tomorrow, inshallah.